Hi, I'm Joe Springer, editor of the Wall Street Exclusive and certified technical trainer, and I'm here to help you make informed decisions so you can succeed in the market. Today I want to tell you about a stock that I think is on its way to doubling over time, Michaels Companies. We added Michaels to the Daily Double portfolio on January 15th. It's up more than 20% since then, and we think it's only the beginning of a long-term story with a very bright future. Michaels is the largest arts and crafts retailer in North America with 1,168 Michaels stores and 121 Aaron Brothers stores in the US and Canada. Michaels Companies was incorporated in 1983, but it's something of a new company because new management took over about 2 years ago and Michaels only went public last summer. Quick! Name a retailer that's taking market share and doesn't rhyme with Jamazon. There are some, of course, but perhaps not very many with the advantages that Michaels enjoys. The three things we like best about Michaels are, 1, the in-store experience. Michaels is taking market share in one of the most hands-on of consumer markets, arts and crafts. This hands-onness inherently gives arts and crafts retailers a degree of protection from online giant of Amazon. People want to go into the store and handle the tactile merchandise. As the largest player in the industry, Michaels offers over 36,000 items that it turns over regularly to offer novelty that people like to browse for in the store. In addition, new management has focused on the in-store experience, providing what they call a customer-centric shopping environment. Management revamped the stores with Wi-Fi and price scanners and higher cleanliness standards, a consistent dress code, new signage, and improved sight lines, which also reduces shrinkage, not Seinfeld shrinkage, accounting shrinkage, also known as theft. Additionally, Michaels does in-store crafting classes and events centered on new project ideas and holiday themes. It also offers frames and framing services, which accounts for nearly 1/5 of its sales, and again brings in the foot traffic. 2, proprietary products. About half of Michaels' revenue comes from its own proprietary products that are not available anywhere else. These proprietary products not only help it to capture market share, they also have better margins than the products Michaels does not produce. Michaels' proprietary products and economies of scale as the largest player also allow it to have an aggressive e-commerce program. Half of Michaels' online offerings are not available anywhere else, and the costs of its online presence are spread over its large existing customer base, giving it scale. 3, best player in one of the best markets. Arts and crafts is an industry that is very unlikely to be replaced by new technology. It is a low growth industry, but one with staying power to rival almost any industry. As we saw, arts and crafts retailers in general should enjoy a degree of protection from Amazon. As the largest player, Michaels has the best scale for its proprietary products, the in-store experience, and its e-commerce program. The leading arts and crafts player in the US should be able to grow its market share because of its advantages, and that seems to be the case with Michaels. Many retailers reported disappointing holiday sales, but Michaels just reported sales growth of 3.5% in the most recent holiday period year on year. That's an especially healthy number considering that 2013 holiday period was driven by a very strong rainbow loom fad that has now normalized. Michaels looks like an exceptionally healthy retailer, the best player in one of the best retail markets. It looks like one of the highest quality brick and mortar retailers, period. One that should only get healthier over time, Amazon be darned. Michaels deserves to trade at a premium to the market, but it looks priced like an average company. Michaels will have about $660 million in operating income for 2014. It has a market cap of about $5.5 billion with debt of $2.5 billion. That makes for an enterprise to earnings before interest and taxes ratio of about 12. That is not a super cheap ratio of below 10 or so, but it does seem like a very good value for a company with such great characteristics. Michaels has had a nice little run, but it should be the dominant player for quite some time in something of an eternal industry. It is still not even close to expensive in our view. We think it's just the beginning for Michaels. For the Wall Street Exclusive, I'm Joe Springer, helping you make informed decisions so you can succeed in the market.